Hello, and this time on the Mortgage and Protection podcast, we are continuing the conversation on buy-to-let portfolio mortgages with Paul from Henchurch Lane. Welcome back, Paul. Thank you for joining us again.
Hello, Tessa. How are we today?
I'm all good, thank you. A little bit chilly, but other than that, all good. How are you?
Yes, indeed. Yeah, all good. Certainly, weather has changed. Finally,
It
uh,
has.
it's a
Mm.
constant battle in the office between the females and the males in terms of the heating situation. So we're in the thick of that at the moment, which is lovely.
It's so true, isn't it? Yes, we're recording this in November 2024. So the weather is changing. Well, let's get straight into the rest of the questions that we've got here. This is a part two, so we've got more questions on this. So people would like to know, are there any restrictions on the types of tenancies that can be considered for a portfolio landlord mortgage?
Yes, there are. So restrictions, as we all know, with regards to mortgages and lenders, are going to vary from lender to lender, and that's just generally the mortgage world across the board. But as an example, with a standard AST, which is an assured short-term tenancy, lenders usually are going to like those to be in a range from sort of 6 to 12 months. And you might struggle if they're sort of unusually longer terms than that. So other cases that we tend to see are slightly more difficult. Things like HMOs, holiday lets, supported or vulnerable housing, or lets to like a corporate or a company setup. So those sorts of things are generally going to come with different restrictions depending on what lender you go to. Um, so while sort of standard AST, sorry, are widely accepted, your non-traditional tenancies are likely to require, a little bit more of a specialist lender approach or potentially additional documentation. So just make sure you consult with your broker. They're going to understand the specifics of your portfolio and they're ultimately going to match that with the correct lender.
Right, okay, brilliant. So some points there to bear in mind. Let's move on to this question then. Can a portfolio landlord mortgage be used for both residential and commercial properties?
Yeah. Yeah. So many portfolio landlord mortgages or portfolios in general focus heavily more towards the residential properties, but some lenders accommodate mixed use. So you might have a semi-commercial or just full commercial property. So you can achieve that as well. Commercial loans are going to tend to come with those slightly higher interest rates as they're just a bit of a bigger risk from a lending perspective. And you're again, likely to need a little bit more experience in that space. Otherwise, it's just going to be a little bit more difficult for you to secure that. But again, as long as you're working with a with a specialist broker, you're going to be able to source the best and most suited lender for your choices.
Okay, there we go. So that answers that one there. Now, with this next question, I'm not sure how much you can say, but are there any specific tax implications or considerations for portfolio landlords?
Yeah, okay. So I certainly can't give advice, and I'm not going to be throwing around percentages as such because every situation is different from a tax perspective, and I'm not a tax advisor.
Mm,
But tax implications for portfolio landlords can become rather or quite complex, to say the
mm.
least. So especially as your portfolio grows, it can be very layered. So it's crucial that you're going to consult a property tax specialist, ideally, but at least an accountant, a decent accountant that's going to help you avoid costly mistakes when you make these sorts of choices. So, as we know, any income or any profit is going to get taxed in one way or another, right? So
Mm.
it's one of those things in life that you can be certain of. Um, when you buy a property, let's start from the beginning. When you buy a property, you're going to pay stamp duty tax. When you own the property, if it's in your personal name, then you're going to pay income tax on the profits. If you own it for a limited company, you're going to pay corporation tax. So they're going to be taxed. If
Mm.
it's a commercial property and you let it, that could also be subject to VAT, so value added tax. And when you sell it, you're going to potentially pay capital gains tax on any gains that you've made, or again, corporation tax if it's in a limited company. Oh, and when you die, it's going to become liable to inheritance tax as well, right? So hardly seems worth it when you go through that many taxes. But in all seriousness, it can still be a really, really profitable investment if it's done correctly. So it's just worth understanding those taxes and making sure your business model and your strategy allows you to be profitable as an investor.
Okay, so a key point there, really. So let's move on to this question. This is interesting. Are there any government schemes or support available specifically for buy-to-let investors with a property portfolio?
Yeah, so when I first read this question, when you sent it over, I thought to myself, I think the author of this question was wishful thinking a little bit. But on reflection, there's actually, nothing in comparison to like your first time buyers or residentials, but there are a fair amount of things to mention. So, there's some initiatives, there's some like support mechanisms that are going to be available for portfolio landlords to take advantage of. So we'll cover a couple of those. So the ECO, which is the energy company obligation, that's going to provide funding for energy saving improvements like insulation and heating systems. And generally, it's going to be especially for properties with tenants with low incomes. So if your portfolio is sort of built around those kinds of tenants, then it might be worth looking into the ECO. Property improvement loans as well. So some councils actually offer low interest loans or grants to landlords. And again, it's going to be to make improvements to the property on a let's say on an energy efficiency basis or even on a safety basis.
Mm.
And again, that's going to be probably more available in areas where there are housing shortages. So again, take note of that if that does, tick the box for your portfolio. Tax relief, I didn't really think of this one as an incentive or as government support, but realistically, any kind of ability to offset costs and save tax it is really from the government. So as a limited company, if you were to buy a property in a limited company or a special purpose vehicle, then you can actually offset the interest payments for your mortgage, which ultimately then means that your tax bill for those profits is much lower than if you bought it in your personal names, because you can only offset 20% of that interest, which means your profits are much larger and then larger tax off the back of that as well. So definitely one to take note of, and hopefully we'll be doing a little bit more around limited company stuff and the benefits of that specifically in future podcasts.
Yes, definitely. Well, there we go. That's useful to know there. Okay, so we're getting through these questions now. There's quite a few, isn't there?
There
So this one here asks, is it possible to switch lenders or remortgage a portfolio landlord mortgage?
Absolutely, yes, you can, subject to obviously all the criteria and affordability. It's usually going to be a bit more difficult than, let's say, a non-portfolio case for multiple reasons. So you're going to have to bear in mind things like portfolio assessments. So lenders will assess your entire portfolio, despite you only asking them for a mortgage on a specific property. They're going to look at everything in the background. They're going to need things like property values, loan sizes and rental incomes and that sort of information on the background properties. And they're going to look to stress that as a business model, really, rather than just the individual or isolated case that you're looking at. Excuse me. They're going to
Bless
they're going
you.
to apply they're going to apply a stress test to that entire portfolio. So because of that, they're likely to need much more documentation, much more evidence. But all that being said, there can be lots of positives, obviously, to remortgaging, a portfolio landlord case, especially if you're looking to maybe obtain a better rate or maybe do some capital raising, for things like renovations on the property, or even to pay for a deposit on a future buy-to-let purchase. So, despite it being slightly more difficult than it would be, it's definitely worth looking at.
Okay, yes, lots of reasons as to why you might do that. Okay, so people would also like to know then, what role does rental income play in obtaining a portfolio landlord mortgage? You might have touched on this in
Yeah,
part one,
so
maybe.
I did, and we sort of went into the calculations and things like that. But
Mm.
to reiterate, I suppose rental income really is probably the foundational element, I would say, in securing any kind of mortgage, but especially with it when it comes to portfolio mortgages. So the lenders are going to use that really as a gauge for affordability, looking to look at the portfolio viability, and they're going to determine how much they're going to be willing to lend, all based on the rental figures, right? So to give a little bit more info, we probably touched on this in the previous podcast, but
Mm.
they're going to apply a stress test to arrive at a maximum loan. And that's going to be typically something like 125 to 145% of the interest payments need to be covered by the rent. And they're going to stress that on something around 6%. And again, those brackets and those figures are all going to differ from lender to lender, but that's the sort of coverage that they're going to apply to their affordability calculations to make sure that you're protected by things like market fluctuations. But all lenders are different. It's the same idea. The bigger the gap, I suppose, between the interest payments and the rent, the better. As that gap gets smaller and smaller, it becomes more and more difficult to secure a decent mortgage.
Right, okay, there we go. So that answers that one there. Now, this next question follows on. So, how does the interest rate on a portfolio landlord mortgage compare to other types of mortgages?
It's more. In a nutshell, they are more expensive. You can get rates that are quite close to a standard buy to let, but generally it's going to be a little bit more. And again, that's to cover the risk of market fluctuation. So it's a riskier bit of business for a lender. You're more exposed to vulnerabilities by having a multiple properties in the background. If there was a fluctuation, that's obviously going to hit your business model much harder than it would if you just had one. And because of that, they obviously have slightly more expensive rates. But that being said, if you set it up properly, it could still be even more profitable than a mortgage with a much smaller rate because you can offset interest and things like that as well. So, yeah, it is just knowing the ins and outs and how you should really set up your business model.
Okay, so a key pointer there, really. Now we've got two questions left. So the next one here asks, can a portfolio landlord mortgage be obtained for properties owned jointly with others?
Yeah. Okay, so the questions are maybe a little bit backwards.
Hmm.
If someone on the mortgage application has four or more mortgaged buy-to-let properties, you will have to get a portfolio mortgage, or you will be deemed as a portfolio landlord, thus only having access to those mortgages. So that's really it. That's the criteria. If either of you or any people on the application have four or more mortgage properties, not just properties, but buy-to-let properties with a mortgage on them, they automatically fall into that definition, and therefore you will only have access to portfolio mortgages.
Right, okay, which makes sense there. And now another question here asks, what are the consequences of defaulting on a buy-to-let portfolio mortgage? What are the potential risks involved?
Repossession, ultimately. If you don't keep up with your mortgage repayments, you run the risk of your property being repossessed. I'm sure everybody's seen that disclosure slapped on any kind of financial advice or any marketing.
Mm.
So that's obviously worst case or the worst extreme. On the other extreme, if you miss a payment or if you default on a payment, then it's going to affect your credit status. And because it's a secured loan against an asset, the damage that will do to your credit is much worse than if it was unsecured or if it was like your utility bills or your phone contracts or anything like that. So almost certainly you want to try and avoid missing any
Mm.
mortgage payments across the board because it's just going to hurt you in the future trying to obtain credit.
Yes, definitely. And that caveat there, you'll hear it on the end of this episode as
Yes.
well. Now, we've covered an awful lot there between our part one, part two episodes, but have you got anything else you'd like to add? I mean, you've demonstrated how a mortgage broker can help, but any final thoughts?
Yeah, I suppose throughout all the points we've covered off what I'd like people to take away from it. But realistically, the highlighted areas are make sure you've got the right team of people around you, I suppose. Make sure you've got the right advice from a tax specialist. Make sure you're using a broker, not only a broker that's good at what they do, but that specializes within portfolio cases because they're just so much more layered and so much more in depth. There's so much more to take into account when you're becoming effectively a professional landlord, right? So you've actually got a
Mm.
business that's got multiple properties in it. And if you run it correctly, then it could be a path to early retirement. If you run it poorly, however, it could be a path to really late retirement.
Mm.
So
Yes.
yeah, it's a takeaway for you.
There we go. Yeah, there we go. I was going to say a good note to end on there, but maybe food for thought.
Yeah, maybe a slightly negative note, but just hammering home the importance
Mm.
of actually speaking to the right people, I suppose.
Definitely. There we go. Well, hopefully that has proved useful. There's lots there to unpack, isn't there? And Paul, I'm sure we'll catch you on another episode soon.
I look forward to it.